I'm going to attempt to do a quick example of a mutual fund versus an ETF. This is Invesco's Developing Markets Mutual Funds. It mimics what's happening in emerging markets, which would be Asia, mostly, maybe Brazil, maybe some European companies. This next one is iShares, and it's an emerging market fund as well, but it's an ETF. You can see here that the percentage just moved, where on the other one, this is going to stay the same all day long. This one fluctuates with the market as the market fluxes. And this one here is a directions fund. It's an option play of the emerging markets. It will triple the up or down of whatever this particular fund is doing. So notice now we're at 1.28, it was at 1.26. It's moving. So if I hit a one-day chart, you can see this is what's been going on throughout the day. So it started kind of up and it's just kind of flatlining here. A little bit on the downside, but basically just pretty much flat, up at 1.25%. Whereas this one here is only showing me what happened yesterday at the close of the market. The market in Pacific time closes at 1 o'clock. 4 to 5 o'clock is when you'll see your actual price. So you don't really know what you're buying or selling, what prices you're getting in at. It just is going to be whatever it is at the end of the day. So if I go to the one-day chart, you're not going to get anything because nothing happens in just a single day. I can go 5-day, and it just shows me where it ended at the end of those days. Okay, this is not a fluctuation during the day. It's just where it ended from day to day versus an ETF. If I select 5 days, you can see that on this day it went up, and then here's this white represents a day, and it went down. There's something that happened in the beginning of the market, and it's crashed right away, and then it kind of held flat. Then good news came out, and it went up, and then it kind of held flat here, and then this morning it shot up for whatever reason, and then it's kind of holding flat. So again, you can see as I drag my cursor around here, this is any given moment during that day giving me different prices, whereas your emerging market, you only get one price. The reason why I prefer the ETFs is because I can get it out anytime I want at that moment. From 1 hour before the market closes to 1 hour after the market closes, I could get in or out of an ETF. A mutual fund, once you're invested, you're in. You can't get out till the close of business. So if the market were crashing, there's no way to hurry up and sell. If the market crashes by the end of the day, that's what it is on a mutual fund. But when you have a mutual fund, when I see crashes, that's when I'll buy for a long-term investment if it's a fund I believe in. All right, so this is your ETF with options that triples what's going on in the market. You can see it shot right up, and it's kind of level here as well. So the charts are going to look the same, but your percentages are going to be much different here. So this is a lot more risk on this investment. There's a lot more reward and a lot more losses. All right, so that's the difference between ETFs with the options, your ETF, emerging market fund, and an example of a mutual fund. Hope that helps you understand the differences on how those work.